What's up, guys? Mike Sharp here again. This is Sharp Investing, not investment advice. Okay, so I don't do a lot of videos on portfolio or market direction or economics, but this is going to be one of those. Wanted to update you guys on my portfolio. I've sort of changed strategies here recently, and I've become a lot more defensive. Now, I've only done two videos where I've sort of changed direction. One was early on, like February 22. I said that the Federal Reserve is cutting interest rates, so we have to watch out because that's really bad for asset prices. Earlier this year in January, I said that I thought there was a bull move impulse up because everybody was negative on the market and thought a recession was coming. And so now I'm changing directions and I'm going a lot more defensive with my portfolio. So if you want to see the portfolio, just I'll put a timestamp. You can fast forward. But first off, I'm going to talk about some economic indicators that I'm looking at and why I think there's a bit of a risk here, or maybe a large risk. So I think the main message here is the Fed will get what it wants. It always gets what it wants. And right now what it wants is it wants pain in the economy and it wants unemployment up. And it is going to keep interest rates up until it gets what it wants. The Fed does not have a history of being proactive. They are extremely reactive. I've been watching the market for a while, and I think the last proactive head of the Federal Reserve was Alan Greenspan, and he was still somewhat reactive. These guys now, they just wait. What their system is, they wait for a problem, and then they throw everything at it to fix that problem. But when they fix the problem with all the tools they throw at it, then they create a different problem. They wait for that to hit, and then they change direction. So right now, they are fighting inflation, and they are fighting it very aggressively with very high interest rates. So I think if we look at some of the risks here, one of the main risks I see is that the stock market is extremely mispriced. So if you look at the price earnings ratio, now I'm going to keep this all based on the US, just so you guys know, this will be US focused, but if the US coughs, the rest of the Western world catches a cold. So it's actually the one we need to watch. So right now the S&P 500 is trading at about 24 times earnings, and that means the earnings yield is just over 4%. If you look at the 10-year bond treasury rate, it's almost 5%, which means there is a negative risk premium for stocks. Usually there's a positive 2 to 3% risk premium on stocks, which means that if stocks were priced correctly, they'd be at about a 7% earnings yield, which means the stock market would be at 2450 on the S&P. So that's like, I don't know the math, maybe that's like 40% down from here. So something has to change, right? Bond yields need to come down, treasury yields need to come down, or the stock yield needs to go up. Now, things can be mispriced for quite a long time. I'm not saying this is going to happen next week or next month, but as Ben Graham says, in the long run, it's a weighing machine, and it is misweighed right now. There's probably a better word for it, but I can't think of one. So right now, I think what's happening is people are betting on a soft landing. If you look at Google Trends, I think that's what it's called, where it shows the popularity of search terms, the search term soft landing has never been higher in terms of Google searches, which means the herd, everybody, the same herd that was convinced there was a recession coming in January now thinks it's a soft landing, which is very concerning for me as an investor. So if we look at what soft landing is, it means that the excess can be taken out of the economy and not create a big problem, right? So if we break down how that would have to happen, I could see, two ways of this happening. One is that the Federal Reserve gets to the point where they've kind of defeated inflation, they think they've defeated it, and then they proactively cut rates so that these high rates don't destroy the economy. But as I said before, that is extremely unlikely because the Fed is reactive. They have been chanting higher for longer, higher for longer, higher for longer all this year, and they're still saying it, which means they are not going to get ahead of the problem. They're going to wait for a problem to hit, and then they'll react and maybe cut rates then. And usually they're behind the curve, so the problem will hit, they'll wait to make sure it's a real problem, then they'll throw all the ammunition at it. In which time the economy will have collapsed. That's a big prediction. I don't think the economy has to collapse, but I think there's going to definitely be a problem somewhere, and I don't know where the problem is going to be. Right, it's going to be somewhere unexpected that nobody has thought of probably, or maybe a few people will have thought of it. So the other thing that could happen to create a soft landing is that the economy could just get used to these 5% rates and be able to absorb them. So 5% rates, 7% mortgages, and I think that is also extremely improbable. There is record levels of debt in the system. The government's up to 33 trillion in debt, which means a 5%. If they rolled over all their debt at that, 5% stayed there, rolled it all over, they would be at $1.65 trillion in interest payments alone, and which would make the federal government basically a Ponzi scheme. They take tax revenue in and just pay the interest on the debt. Never mind all the other expenses they have. So 5% is not a tenable rate for the government. It needs to come down. And then there's also record consumer debt in the system at 17 trillion. So there's $50 trillion of debt in the system. And I very much believe that they can't absorb 5+% rates for very long. Here's somewhat of a crude example. So what I hear right now is, hey, look, the Federal Reserve raised these rates and there's no problem. Wow, maybe we were wrong. Maybe this is just fine, right? And it's not going to create a problem. And so people are saying, oh, good, we're actually not at the mercy of interest rates like we have been throughout human history. And to me, the crude example is, it's like a guy who goes to the bar every night for a week, picks up a different woman every night, goes home, sleeps with her without a condom, and a couple of weeks later, he gets tests back saying he doesn't have an STD, hears from the women, oh, they're not pregnant. Hey, look, it's fine. People were making such a big deal about condoms. BS, I don't need to use them. See, nothing bad happens. That's exactly what I think is happening here with the economy. Eventually, if we keep doing this, there's going to be a problem. Okay, some of the data that I'm looking at, no, there's a lot actually. You can basically make an argument for anything economically right now. You could say, oh, it's going to be a bull market, the economy is doing great, or it's terrible and it's a disaster and everything's going to fall apart. So don't read too much into these data points because there's a lot of other data points. But some of the things I'm looking at there's a leading indicator index, and that is flashing red now for a few months, showing that some of these lagging indicators that indicate we're doing great as an economy, they're saying actually the problem is right over the hill here, and the Federal Reserve is typically backwards looking, right? They don't look at forward looking data. They say they're data driven, which means they're looking in the rearview mirror, driving forward. So there's defaults happening in the system. Car loans is the first place it started to happen earlier this year. So that's showing there are problems in credit. Now those haven't moved into other areas like housing. But if we look at housing a little bit, we might see that there's a problem on the horizon, right? So one of the arguments against housing being a problem is, okay, everybody's locked in at 30-year fixed rate mortgages. Now, not everyone is, obviously, but there's a high percentage in the US. The rest of the world, there's a lot more sort of variable rate loans. Like I'm in Canada, and I know a lot of people on variable rate, and they're choking on them right now. And so those are a real problem. In the US, there's a small number of, I think they call them adjustable rate mortgages there. But as we learned in the 2008 Great Financial Crisis, you don't need a huge percentage of the overall pie to default to create a massive problem. Like you could have 3% of mortgages fail and it would create a systemic problem. So that's one argument against the sort of 30-year fixed rate safety net. But I think the bigger problem is if we look at the mortgage originations, 2023 is set to be the lowest total originations ever since they've tracked this metric, which means the houses are not moving. People with these 30-year mortgages aren't moving because they'd have to remortgage at a higher rate, so they're just holding on to their place. New people can't really get into the market because the rates are so high and the prices are still high. They can't afford the payments. So houses are not moving right now, and so I think that there might be a sort of a lateral problem this is creating in employment. Now, I've seen some different metrics, but I think residential housing is around 10% of the overall economy. And if that is not happening, the construction's not happening to the same degree, houses aren't moving, you've got brokers, agents, things like that. These people are their income's going down, and they are going to start looking for employment in different areas because the employment in that sector is weakening pretty fast. So the problem with the interest rates, it creates housing that doesn't move, which creates employment problems. And if you have these employment problems, people stop making money. As Dalio tells us, one person's spending is another person's income. So if this person's not making money, they're not spending as much, that hurts this person's income, they don't spend as much, the next person's income gets hurt. So that's how the recession dominoes happen, and it can start just in one area. So I think there could be problems on the employment side of this. Also in real estate, I think everyone knows commercial real estate is having a very bad time, right? Because they have the twin issues of, demand is down because work from home took a chunk of that market offline. And so there's too much supply right now. And plus you add in the high interest rates and the high cap rates, the stuff isn't moving, right? Because people that can't finance these at these rates. So that is also 5% of the economy. And so if all that real estate there is about 15%, that's a pretty big chunk to have a problem in. And I think it's only a matter of time, right? Like, so the main message here is, and the problem could show up somewhere else, right? Corporate debt, you've got zombie companies that have to remortgage or sort of renew their loans at these higher rates. They might not be able to do it, right? So corporate credit could end up being a problem too. I don't know exactly where the problem is going to be, but I know that interest rates are basically a law of nature, right? If you raise interest rates this much, you're not going to get by and not have a problem. There will be one. I don't know when, I don't know where, but it's coming. So I'm defending myself for that day. That said, I'm going to talk about my portfolio here really quickly. So what I've done to sort of batten down the hatches a little bit is, if you watch some of my other videos, I've sold Meta, I've sold Teva, and basically I'm just keeping that in cash. Right now I have about 20% in cash. I've also increased my flow traders position. And so that I think it hasn't worked yet, but I do still think it's a counter-cyclical position. They do well when there's high volatility. So if you actually have a stock market crash, they will make a ton of money. And then the other reason why they might do well longer term, a little bit longer, it's still short term, but like maybe 1-2 years, is that they are very interest rate sensitive because they have a large dividend, and comparing to the 5% treasury rates, it makes that stock a little bit less attractive. So if you have an economic meltdown, maybe stock market comes down, the Federal Reserve would, and the ECB and everybody else would cut rates, which makes these dividends more attractive. And I think that's why the stock has come down over the last X number of months, because the dividend is just not as attractive. They're not making as much money because there's almost no volatility in the system. But you could have a flip on both of those at the same time in a negative economic stock market situation. Stone Co., PDD, and Alibaba, I'm going to keep these three because my view on them is that even if you have economic problems, they're still all going to do quite well. And I think they're all still going to grow, even if you have recessions around the world. I think those are very strong companies, and they're cheap based on their growth rate and their profitability right now. So I don't see any reason why I should let them go. Those are my long-term holdings. I'm just going to leave those and not sort of like try and time the market with them. Liberty Global, I could sell that for cash if I needed to. I'm still figuring out what I want to do with that one. But right now their buyback rate is probably around 20% annualized as the stock trades around $16. So there is a pretty good argument for just keeping that too. And I think that their earnings will be somewhat stable even if there's an economic mess. People aren't going to cancel their internet plans for their home or their mobile phone plans. Like, those are pretty non-cyclical, not counter-cyclical, but they're not very cyclical. And then the smaller ones, I have some Australian Family Legal, which is a small position. I'm still figuring out what I want to do with that. Their situation has changed quite a lot since I bought it. And then I have some precious metals positions, which have been terrible, and they're kind of a hedge just in case all these currencies go to shit, and you get a real spike in gold and silver prices. But those are sort of like long shot. I wouldn't recommend following me into stuff like that. But that's sort of my take right now. I'm defensive, and I'm concerned that there's not a lot of upside here. Now, the stock market could go up another 20, 50%. Who knows, right? Stocks can be irrational for a long period of time, but I don't think that they are a great bet right now, generally, just because of the valuation and because of interest rates in general. So that's it for this video. I hope you got something from that, and I will see you in the next video. Thanks.